Good day all. Ira Epstein of Linn Associates with your financial market wrap-up. And this is for Wednesday, the 4th of March, 2020 at 5:15 p.m. Well, we're sharply lower in the stocks, or I don't know what sharply is anymore. Fair question, fair answer. What is sharp in this volatility? I don't know. I've been around this game a long time. I've never seen these past few days' action quite the way that it is. Does it mean that people are gobbling up on the break and thinking we've got V-bottoms in some markets? Could be. Is the market just gotten overdone real quickly, giving you a bounce to get out? Could be. It's something for everybody is what's going on. We saw United Airlines canceling more flights. We're seeing more spread of the COVID-19 virus. Italy is just shut down, from what I understand, their schools for 2 weeks. We know that Japan's already closed for a month. How long can it be before somebody in one of our schools gets that and the next step comes? You may think it's all rosy. I still wonder how bad it really is. And we've got the new test kits going out this week. You're not going to find less people with it. You're going to find more. That does not mean I'm a bear, a pundit, or anything. I understand what's going on. That's all. When we come to the energy market, you know that OPEC is meeting. So I don't expect the market. I was surprised it was even down today, to be honest. I would expect they're going to do something to try to give the market a bid, not break the back of the market. We'll see what goes on. When we look at the S&P, you've had a dramatic move. This is just a close-only chart. Look at that high to that low and you're getting a bounce. That's all I see. Could it be a V bottom? I guess so, but I don't see it yet. Here are Fibonacci numbers. So what I did is I took the most recent high to the most recent low. This is a 1/3 retracement. This is a 50% retracement. Bear markets often don't rally more than 1/3 to 50%. Got it? I'll repeat it again. Bear markets don't rally often beyond the 1/3 to 50% range. And I'm talking approximate. Getting up to the 2/3 count, not that bearish to me at that point. Can still break. I wouldn't be in the camp that way. So this is a zone, that's all I'm saying, where while everybody's saying that's it, it's all behind us already, maybe. Still not showing me what I want to see. When I go to the chart action on the swing lines, I have to have them this narrow because the range is so big to get it on the screen. Lower highs and a low that's lower than the other. 3137 is the number you have to take out to break the pattern of lower highs, lower lows. You can see this number's right in that range, isn't it? That's 3150. This is right in that zone. Then I take a look at moving averages. The 100-day average is above that at 3174, and to get to the 18, you might be in the 2/3 area. The point is you still have moving averages above you, which are going to be resistance, and suddenly this 200-day average, which at first we didn't think mattered that much. The market sliced through it like hot knife and butter, right? Kept going down. Well, on this pullback to the upside, suddenly we're hitting it all the time. That's my point. When I look at Bollinger Bands, you would hit the lower Bollinger Band back here. This was just bang. You took the market out of whack, and these moves are dramatic as can be, and the market is caught with momentum trying to turn up. So you've got lower highs. I've left this arrow just show you that maximum low. And now the question is, if you take out 3137 and don't take out 2970, what is that low from today? 2976.50. Without taking out that low, the swing line would turn up. I'd still contend you have a lot of resistance right there, but what market swings? Then we get to the NASDAQ. Is this going to be a V bottom? You hit the 200-day average, bounced away. Now we've played for 3 days in a row, basically, at the 100-day average. The next resistance point to get to it, the 18-day average, you have to break the pattern of lower highs and lower lows. So the number that you have to watch is 302.50. Why don't you go, I'm sorry, did I say 302? It's 902.50. Go run your Fibonacci numbers. Take your chart work. I can't do this all for you here. Hit the top there and the bottom and you get an idea where you're at in this. Dow, do the same for yourself. Go to this high. Figure out the high right here. to that break low. But you have a lot of resistance. You had a bearish crossover just happen today, tonight, right now. The market just got to the point where the 18-day average in red, this was the close today on Wednesday. Remember, we're in Thursday's action when I do it this late. You had a bearish crossover. So now you got another bearish element that hit the chart. The 200-day average is certainly a resistance point. Haven't been able to make it back to it yet. So still problems. And what has the market done on the rally? It's gotten out of oversold condition. It could be giving more ammunition. I know you're going to think this is nuts to the bears. Just be careful. On the Russell, you had a bearish crossover the other day. Now, like the Dow, you've got the 18-day average. The next site here is the 200-day average, same in that one. We'll see. I am not with the other people that are saying we've made V bottoms in that. Don't see it as a chartist. The VIX, getting down into a range that's a little more normal, but still highly elevated. 30 is not where you were when you were sitting here for a good part, in fact, all of last year almost, in the 10.5 to 15, 20 range. You had moves up to 50. I told you to go look at it back in February of last year. You got there, and we'll see what happens. You're still elevated. Be careful now of the bonds. This is probably a good time to say enough. TLT on the close, the ETF lost its embedded reading. In the early trade tonight, you've lost the embedded reading in the March bonds. When that happens, it's a sign that this wave of bullishness is coming to an end. Could it re-embed tonight? It absolutely could. There's a difference between you're bullish and coming out of a market and getting bearish at the top. That is not what I'm saying. But I am saying it's a warning sign to those longs, big one. You haven't quite done it in the 10-year note. It is still fully embedded. You're getting your play on the longer term instruments right now. But I'd still be careful. If they go, you might pull back here. Remember, we had gotten over to the left-hand side of the Bollinger Band. Now we're spending time on the right-hand side. You've watched historic lows day after day. The question is, will they continue? All it will take to have it continue is more sparks. Can you imagine the first school closing? I'll repeat it again. Could you imagine the first major U.S. Sporting event with nobody in it? It can happen. This is not science fiction. I never thought you'd see Japanese schools closed for a month. I didn't think you'd see Italian schools in certain provinces closed for 2 weeks now. I can go on and on. This is something you got to be careful of, and it is spreading. And as we have 75,000 test kits going out in America this week around the country, are they going to find less cases? I don't think so. In the dollar index, we've come down to an important zone, the 100-day average in the lower Bollinger Band. And you've had this monstrous straight down decline. I think the pros are saying they're taking some money off the table. We also have tomorrow, Thursday, and then we have to go into Friday's news. You know, the interesting thing is the Chinese news isn't as bad as it's been. It's much better. It's other countries where it's spreading, be it the UK, Spain, France. It's moving around and moving fast. In the Eurocurrency, we've pulled back to what I was hoping we would see. We had this crazy move to the upside. You normally pay more attention to the 100-day and the upper Bollinger Band than that. It just didn't take a very long time. It's now doing what I thought it would do. Will the market embed, or is the market the flip-flop of the dollar in need of a bit of a correction? This type of vertical move is very hard to get involved with. You've gone from 107 to all purposes 112, and you're trying to get bullish at 112 again. Where do you put a stop if you do that? In the yen, same thing. You've had this massive vertical rise. Will the market come back and challenge the 100-day average? It's already paying good attention to the upper Bollinger Band. It is not embedded. It is the first night where both numbers are over 80. You didn't close both numbers over 80 yesterday. So you're overbought up there. In Bitcoin, is it going to get an embedded reading and challenge these lower numbers again, or is it going to get over this 90-30 and start another move to the upside? Now, if we watch what it's done, Here are the numbers. They're both not under 20, and this was Monday. They both got under 20 yesterday. They both got under 20 on a closing basis today, and on the reopen tonight, they're there. Now, if they close this way, the odds favor the market's going to challenge the 100-day average and possibly that lower Bollinger Band. If you flip during the day through 90-30, you're probably not going to do that, and you might put in sights that price wants to go back up here. We'll see. But what are we doing? Sideways churn at this point, deciding if there's another bear part to the market coming. In the Brent versus the WTI crude, okay, we're back under 439. We had gotten back to this $5 area, pulled back right through here. You would think that Brent would gain on WTI, but it's not. It's actually losing a little ground. The lower the numbers go, the closer the prices get. Tonight we're up about 50 cents, but the trend is what? Still down. Lower highs, lower lows. I contend that right here, the first area that the pros started taking money off the table. You're in that general zone, as you can see, and you're oversold. Now, what is OPEC going to do? If they do something to kick the market through the highs of Tuesday, and this would be 53.66, then look for a challenge of the 18-day average, and you stepped out of the downtrend for the meantime. If you can't get over that number, you're still very much in the bear camp. In the WTI, you got to look at it the same way. Go to Tuesday's high, take it out. Probably unwelcome to be short anymore. That doesn't mean you get a big rally because the 18-day average is above you, but it does mean that you've ended the pattern of lower highs, lower lows, so that bear move might be over. A lot's going to depend on demand for oil and what OPEC does. OPEC can't change demand. When I heard United Airlines cutting back more flights, when I'm hearing that the largest domestic carrier in the UK might go into receivership, it needs government help. Everybody's air, travel, hotels, they are in trouble. People are hunkering down worldwide. When you look at gasoline, lower highs, lower lows. Momentum oversold as can be. If you can take out 158.10, enough on the downside. That's how I'm looking at it. I still think Americans are going to stay in America spring and summer. I think world travel is not going to be the event this year. We don't know when the COVID-19 comes to an end. And for that reason, I still think gasoline demand will show up as it typically does for the driving season. What was this chart? That was ERBK. That's the rebob there. This is natural gas. I've got it called gasoline. I apologize. This is nat gas. And you're still in the lower highs, lower lows. I changed to May today, and that's just my error. I'm looking at the symbol. I know what it is. You're getting a bounce. Will you be able to fight at this 18-day average? You've been in a bear trend that's worked its way over, where it's no longer oversold. You don't want to see the lows of today, Wednesday, taken out. Could mean another leg down. If the market rallies, the key is to get over this high. And that high, just so we know in the May, whoops, I want to get to that high. There we go. That high is 192.40. Getting up and over it and closing over the 18-day average would be a sign that this market is trying to get itself back in line with the seasonals, which are often now to the upside. I know it sounds nuts, but they're often to the upside at this time of the year, so I watch them. Who's in control going home? The bears. Until that occurs, they're still in control, and just getting out of oversold condition can offer them with ammunition to get more bearish. What I look at during the day, on days especially like today, were these crazy pivot points in the market. Why? You get to market extremes. Do they have any meaning, or have you just blown them out? That's number one. Number two, as a tool to see what the day traders might be doing, gives me an idea. In most cases today of the super volatile markets, these lost their meaning. That's not always the case. There are plenty of markets where it was working during the day. But in the crazy stock market, my God, it was nuts. You get what's called resistance points, a neutral point, and then support points. And they'll come into the chart looking like this. And what you're trying to do is on an extreme. As a day trader, and this is not a position trading tool, they're trying to sell the market to buy back at these lower numbers, or buy the markets to get back to the pivot or the first number there. And they can do it in layers. And a lot of the traders that use this use momentum with it. I happen to be a fan of the slow stochastic. Probably the most popular are MACDs. but I like this one better. I think it has more of a personality, and that's because it gets overbought, oversold, or can embed, and you don't really do that in MACD. To get this, go to our website. Under free offers, you'll get the 3-part video series with it. Comes right out to you with the links, that's all you need. Click up here, same thing, it'll take you over to free offers, or call my staff, they'll take care of you. I'm Ira, winded day, you have a good one.